Good morning and welcome to Bazaar Morning Call. I am Manoj Singhal from the Noida studio, and joining me from Mumbai studio, of course, we have Prashant and Sonia as always. Prashant, Sonia, good morning. It's a very strong global setting, right? The Indian market, of course, has been strong regardless, but very strong global cues. So perhaps the market in for some more good times. In fact, if you see the data, the Nifty has outperformed the S&P 500 by 17% this year and within 4% of new high, while S&P 500 is 15% off. And the big question is, are we ready for life again above 18,000 mark? We'll find out. For starters, SGX Nifty indicating that maybe we've already had a rally, so some consolidation may not hurt. Hi guys, good morning.
Hi Anuj, good morning. Prashant, good morning. And as someone was saying on Friday, right, ab ki baar 18,000. So perhaps that's what the market is also waiting for quite keenly. But as you said, I mean, Anuj, global risk on is definitely back, right? I mean, just look at what's happening in the global markets right now as we speak. The Japanese market is up about 310 points. You have the Dow, which was up 370 points. And there was a 3-week losing streak in the US, and that has now come to an end. The Dow gained almost 3% last week. Now, there's a lot of data to look forward to this week. There's the US CPI data that comes out on Thursday. Then come the 28th, there's the US Fed meeting. We all know that it's going to be the third consecutive rate hike by the US to the tune of almost 75 basis points. I think that's pretty much digested by the market, or at least that's the base case assumption. But what's happening back home in India? I mean, it's been large buying from FIs, over 2,100 crores is what you've seen. And not just the Nifty, which is above 17,800. The Bank Nifty closed at a 10-month high. The mid-cap index has now gained for 12 straight weeks. And there's more positive data coming out from the banks where the RBI, credit growth data shows that credit growth is at a 9-year high of 15.5%. In any case, we've seen stocks like ICICI Bank hitting new highs. But Anuj, that's the question, right? If this market has another leg up, which it seems like it does, will it be led largely by the financials because IT has taken a back seat? What does the texture of the market look like now?
Yes, Sonia, that's interesting. Actually, that's what I'm focusing on this morning. And my sense is, as you said, the banks have already done their bit. And it's something which the market has also priced in. I was making this point over the weekend as well about how a lot of buying has happened in the banks. Look, the market might just go through some kind of sector rotation. Because, when you get very close to lifetime high, this happens that, you see a bit of sector rotation. IT, for example, I made this point on Friday as well, is perhaps in for a bit of a tactical rally. It may still be in a bear market, but it's showing signs of a double bottom and tactical buying. What is this tactical buying? Ahead of earnings season, expectation of Infosys buyback, and the fact that, even NASDAQ has shown signs of bounce back. In fact, the NASDAQ on Friday led the US market. So my sense is that for the near term, perhaps IT could play a bit of a catch-up. Last week you saw first signs of profit taking in the leadership pocket. FMCG, autos, these stocks did see some profit taking, though Bank Nifty, of course, still remained quite strong. Now, the Nifty IT is 27% off its 52-week highs. As I said, it's still in a bear market, but within that, perhaps it could have a bit of a tactical play. Over the medium term, though, absolutely no doubt about what the leadership pocket for the market is. It's the Bank Nifty. And if you look at the data this year, the Nifty is up 2.7%. The Bank Nifty is actually up 14%. That's a big outperformance. Why is Nifty still up 2.7%? Because the Nifty IT is down 26% year to date. X of Nifty IT, actually, the Indian market, most of the indices are trading almost at their lifetime highs, in certain cases above their previous October 2020 highs as well. So that's something which, for me is very heartening. And of course, as I was making this point, FIs have taken a bet on the Indian economy with the recent buying that you've seen in the domestic stocks. All of this subject to the Nifty holding that 20-day exponential moving average, which it has done beautifully. Every time the market's giving you a dip, as long as 17,550, the 20-day exponential moving average is holding, the dip is likely to be bought. But Prashant, what do you have for us? Global market looking quite strong.
Anuj, hi, and wish you all the good food while you're in Delhi. So enjoy it. Yeah, absolutely, Anuj. I mean, things are looking up. I think you put it well when you said that US and global markets are looking better, but that was never a problem for the market here in India, right? The market was doing just fine irrespective. So for what it's worth, I mean, things in the US are also starting to look like maybe there is perhaps a bounce which is overdue. Could the S&P get to about, a little higher from where we are, 42, 4,300 kind of levels? It's possible. Let me explain. So last week, US equities bounced back after 3 straight weeks of falls, declines. The Nasdaq and the S&P 500 were up about 4% week on week. This even as fixed income continues to sell off. There is no real reprieve there, which I'll address a little later. What had happened is that markets over the last many weeks had gone through a series of hawkish events and meetings. There was Jackson Hole, there was that very strong jobs number, and of course there was Mr. Powell back again last week, where he said basically that he reiterated the need for rate hikes, adjustments in policy rates, etc. I'm not even talking about other central bank officials who've kind of spoken through over the last couple of weeks, reiterating all of this. So, all of this basically culminated into last week's ECB meeting, where the ECB took rates from 0% to 75 basis points, 75 basis point hike. And of course, there was the latest Fed Chair Powell's appearance as well. The question is, have we seen a bit of peak hawkishness in the near term? Markets, by the way, have also repriced central banks significantly through the last many weeks that I described. So it's not really clear where the next immediate hawkish impulse is going to come from. And because it's not clear where the next hawkish impulse is going to come from, what markets do is they look for, by implication, dovish risks. The most immediate one is, of course, the consumer price inflation number this week, which is on Tuesday. That will be closely watched. I think the consensus is expecting about 0.3, 0.4% increase. As far as core CPI is concerned, we'll see what the actual number is. Irrespective, a 75 basis point September hike is given. What the CPI report, if it does undershoot, will do is, what the market is pricing post-September, perhaps there may be a downshift in terms of market expectations there. Remember, post-September, the November meeting, the market is expecting, I think, about a 55 basis point hike, and then in December, another 20 basis point hike, 4% terminal rate by the end of this year. So maybe those things change. I don't think this report will change what they'll do on the 21st, which is the week after. But I think post this, there may be a little bit of downshift in terms of expectations. Of course, all this is up in the air. We'll need to see what the actual data points do. But, maybe in the near term, in the US also, we've reached a point of peak hawkishness. So that allows equities as an asset class to bounce a little bit from here. Sonia.
Absolutely. And the US inflation data, of course, it assumes a lot of importance, but the last data point also indicated that inflation is at a 40-year high, right? Yeah. So, and it's been 2 quarters of a fall in growth that we've seen in the US. So that's why this talks of recession. Yeah. I think the Fed has already taken that into consideration and decided what they're going to do in the 20th September meeting. So, a lot to talk about today. And of course, it's going to be an action-packed day because it's the start of the week. Let's kickstart the show on that note. On the equity side, first up, we have Mahesh Nandurkar of Jefferies, who says that their coverage universe margins will likely bottom in FY23. They expect FY24 EBITDA margins to be up 206 basis points year on year, with broad-based substantial margin improvement, excluding IT, metals and chemicals. They highlight 12 stock picks with strong margin trends over FY23-24, including Maruti, TVS Motor, Eicher Motors, Thermax, Adani Ports, Bharti Airtel, Biocon, Cipla, DLF, Lodha, GCPL and Indian Hotels. The only sectors with FY24 margins still lower than FY20 would be IT, staples and cement.
Okay, let's get you some money market views as well. Kunal Sudani of Shin & Bank says inflation will take center stage this week as major economies unveil CPI updates. He says Brent crude prices have bounced back and the Fed speakers continued with their hawkish stance. He adds the dollar index is finding support at 108.2 levels and says for the dollar-rupee pair, 79.35 to 79.4 to a dollar acts as a base, while 79.8 to a dollar is a resistance.
And on the bonds for today, Ajay Magnolia of JM Financial says volatility in crude and US Treasury yields moving upwards have been trying hard to influence the Indian gilts market negatively. He says CPI inflation print today is not likely to impact much. He adds that a strong appetite in the auction on Friday also gave a sense of demand and comfort to traders. He expects the 10-year Benchmark bond yield to trade in a range of 7.15 to 7.20%, and the new one in 7.07 to 7.13% for the day. All right, we have plenty of stocks that we're going to talk about. There's a lot of stock-specific action today. So let's get straight to that. We have a list of green stocks: ICICI Bank, HDFC Bank, SBI, on the back of the credit growth data that came out from the RBI. There's Aurobindo Pharma, Tata Consumer Products, Suntech Realty, DB Realty, KEC International that are on the radar on the back of positive news flow. And Anupam Rasayan and Adani Transmission could be in the red today.
Okay, let's listen into some opinion which we got earlier on inflation and the US markets from former Fed Vice Chair Richard Clarida and Morgan Stanley Investment Management's Andrew Sliman. Listen in.
I think they're going to 4% hell or high water if I had to put it into two boxes. They are data dependent, but that's why they're going to 4%. Inflation is way too high. Inflation was way too high last year. The Fed had a lot of company, and I was part of it in getting the inflation forecast wrong. But job one, and really I think of the Fed right now, until inflation comes down a lot, the Fed's really a single mandate central bank. The chair made clear the Fed knows that if you squander price stability, it's very hard to achieve and sustain maximum employment. So I think that they are data dependent, and the data's inflation's too high, so I think they're going at least to 4%. The problem is that the shock that the economy took globally with the shutdown and the pandemic and the reopening was an enormous shock. It was almost like a war-like shock. So there's been a lot of dislocation, and unfortunately a piece of that is the economy got out of balance last year, in part because of policy and in part because of other measures. And I think Chair Powell is correct that over the long haul, you can't prosper in the economy, as we saw in the 70s. You and I remember the 70s, with high and variable inflation. So I agree, it's not a great place to be in. If it were just Putin, you would be right. But unfortunately, the economy is out of balance now.
The market will end the year higher than where we are simply because companies are not affirming this very negative outlook that, many of the bears have expected. Right. I think the yield curve is telling you that we're going to have problems, but I don't think it's this year. I mean, earnings are proven to be, corporate balance sheets and consumer balance sheets are too strong. That we have been able to withstand the shock. And so that opinion that it's out there, yeah, at some point, it's just not happening yet this year. I think there's a bigger risk next year, but not this year.
All right, so that's some opinion which we got earlier on. But we've got Rupal Agarwal now joining in, Senior Research Analyst, Asia Quantitative Strategy at Bernstein. Rupal, thank you very much. Great to have you with us back on the program. So how are things looking, Rupal, now, according to you and the team at Bernstein? Because there is significant lead lag, right? I mean, the market here in India has rallied on irrespective of whether global markets have been up or down. In the US last week, we saw a bit of turn higher after 3 weeks of falls. No problems here in India. For many weeks now, we were up another 1.5% of the benchmark index. Your thoughts from here?
Yeah, I mean, Prashant, we still remain a little bit more cautious. I think the macro risk still persists, and I sort of agree. The Indian market have been relatively much more resilient. And there have been some external factors to it, along with, of course, the domestic story being strong. But I think that the China, not doing well, and a lot of investors not being comfortable, adding more China exposure has, in some sense, helped this reversal that we've seen in FIs coming back. So I think there have been some external factors. From here on, we are still, remaining more cautious, I would say. There are, of course, signs of some breather coming to the market in the form of if, inflation starts coming down significantly. But I think there's still some time, for that to happen, and hence in the shorter term, we still remain more cautious than being more risk-off.
Okay, Rupal, good morning. So the jury is still out on the U.S. market, right? I mean, India has outperformed and very close to its 52-week highs. But is there a probability, whatever small or high, that the US market makes a visit back towards its recent lows? And in that case, would the Indian market also have to take cognizance of that, or can the outperformance still continue?
I mean, again, I think on the US side, see the way that the markets have behaved till now, it seems like there's a lot more reaction in line with how markets have typically reacted post GFC. So they've sort of reacted in a way that they would have in a QE world, which we are not yet in, right? We are in a QT world. We are in for or we are seeing Fed hiking cycle, and it's not really accommodative. So I think from that standpoint, given that inflation still remains very high, Fed's resolve to bring down inflation remains very high. To me, it looks unlikely that markets are going to rally very strongly. Having said that, if you look at any of the previous bear markets, we've actually seen some of the sharpest and the strongest and the longest bear market rallies, if whenever we've seen the bear markets being very long or more persistent. So we could potentially see both ways volatility increasing, and that's what we expect in US. So I think it's going to be or markets will remain quite volatile, and there will be days like today where we have everything in the green. Again, if you look at what's been driving that, it's broadly positive macro sentiment, which given we are expecting inflation numbers coming next week, we could potentially start seeing that reversal. So as I said, we are still remaining more cautious than very bullish in the shorter term, because the macro risks are still out there.
Okay, you're also cautious on India, you said, right?
Sorry?
Did you also say that you're cautious even on the Indian markets?
We are, yes.
Okay.
Because if you look at how India has moved, yes, India has been very resilient, but broadly the trends have been very similar to US markets. This entire rally that we've seen since June has been completely in line with US.
Okay.
There have been reversal of FIs, but domestics now are becoming less bullish. That could change the sentiment when it comes to India. Valuations again look unsustainable to us, given there is still risk to earnings, there's still risk to margins. So I think and the fact that in India yields are moving higher, and Fed along with Fed, RBI will have to sort of align their own policy, which means that we are looking for a much higher yields, and historically that's again not been great for markets. So I would say that we really tried to find catalysts in the short term for us to become more constructive. Unfortunately, we couldn't find many. So I think that's again the reason why even in India, we are remaining more cautious.
Sure. The reason I asked you is because there are many macros that are turning favorable in India as well, right? I mean, we were looking at the data. Corporate profit to GDP, the ratio is now what? At a decadal high in this year at about 4.3%. And generally, bull markets are based on improvement in corporate profitability. Apart from that as well, I mean, if you look at it, Brent crude prices are down. CPI has fallen for 4-5 straight months. The PMI data has improved. So compared to a global context, don't you think that India could see outsized flows from FIIs even from here on?
So, domestically, I agree. Indian data is looking much better. And, that's been one of the reasons we've started seeing FIs coming back. But as I mentioned earlier, a lot of that has also to do with the fact that other economies are looking much worse. So, yes, we could continue to see some, flow back into India. But again, a lot of that will have to depend on how dollar moves, how yields move in US, because, if it's a larger capital outflow from EM kind of a trade, then India will also face the brunt of it. So I think that's one point. The other thing is that if we look in terms of how India has been moving with US markets, there has been a significantly higher co-movement between India and US equity. And I would say not just India, I mean, in broadly, Asian markets. So until and unless we start becoming quite constructive on US equities, on a standalone basis, it becomes difficult to make an overweight call on India. But relative to some of the other markets, given that India is, of course, the only region where we are still seeing much stronger growth, though, the growth even in India is slowing. That's been one of the reasons why investors have been, more attracted to India in the short term. But we are still remaining more cautious. We still need to see more signs of a broad-based recovery before we start becoming more constructive.
Purely, Rupal, based on your sort of quant models and data, which areas look attractive to you, even now in the Indian context?
So if I look from a sector perspective, I think the last time we spoke, we are pretty much, maintaining a very similar view of this balanced approach of having, more of a barbell portfolio, where on one side we have, your defensive pockets, we have IT, fair bit of staples, but on the other side, we do have inflation hedges like energy, materials. So it's more of a, I would say, more of a balanced and barbell approach than being very overweight or underweight on certain sectors. When it comes to financials, again, we are focused more on or we are recommending more, more bigger banks, which are, relatively less cyclical, but of course not getting into any sectors or stocks which are, quite overvalued. So I think valuation still remains a key criteria to sort of navigate this uncertainty.
Rupal, I know you did touch upon this, but is there a risk that the equity market is perhaps just ignoring the risks? The quantitative tightening pace doubling, the bond market being in a first bear market in decades for first time since 1980. Could this really hurt come October or November? We've seen this in the past, how sometimes the markets ignore cues from money markets, equity markets that is, and the catch-up is rather fast.
I mean, quite likely. In fact, that's broadly the sense that, or the reason why we still remain more cautious. And, the point that I made earlier, markets will always see this very strong bear market rallies or in between rallies before we start seeing, another leg down. So I do think that, there could be another downside which could, beat the previous lows because of, a risk of a recession still out there, the risk of a very aggressive Fed, which again, means yields moving higher, dollar is still quite high. So a lot of these macro risks, I think, are still there, which I do think that markets are not completely pricing in, including, earnings, which have till now been relatively more resilient, but we started seeing an earnings downgrade cycle. And we do think that we are just at the beginning of one. And hence, that could also be one of the key drivers for this next leg down that we could potentially see in the markets.
Okay, Rupal, always a pleasure speaking with you. Thanks a lot for joining us and giving us your call. That's the word coming in from Bernstein on the markets and the way forward. They say that they're cautious, even on markets like India. They're cautious at these levels. The market could see another downside. Well, there are many opinions that make the market, but for now, things have been looking good. So let's take a quick break. On the other side of the break, our list of top 10 stocks is coming up. Stay tuned. Welcome back to Bazaar Morning Call. This morning, the SGX Nifty is absolutely flat, but our own markets have had a stellar run. We're just short of 18,000 by a tad bit. So let's see if this week we can get there. Our research team is here with us to give us a list of top 10 stocks as we begin the day. Anuj, what are you looking at today?
Well, Sonia, this is what I said on Friday as well. And, my sense is just for the tactical bit, there could be a mean reversion trade on IT, which is playing out. It's made a higher bottom, taking support between the 20 and 50-day moving average. Can the index move towards the 200-day moving average? If nothing else, which is 10% off. I think if that happens, if we look at stock like Infosys, for example, it started to see quite a bit of traction from its recent lows. Trading above the 20 and 50, as you can see, it's taken support there. And now, can it move towards the 200-day moving average line, which you're seeing is a bit of a distance away. Will still be a bear market rally, but nonetheless. And similar logic would apply to the stronger stocks in the mid-cap IT stocks, X of Tata Elxsi, L&T Infotech. Again, if you see, it's showing some signs of an upward moving 20-day moving average, and the 200 is quite some distance away. If nothing, just a mean reversion trade, I think, might be playing out. We might have seen start of that last week. Maybe this week continues.
All right. And of course, I mean, the US market, NASDAQ bouncing may sort of help as well as far as the IT space is concerned. Maybe a bounce there as well. Now, Abhishek is standing by with the latest credit growth data, which is also bouncing quite nicely. Abhishek, hi, morning.
Morning, Prashant. As you mentioned, the credit growth is bouncing nicely. And after a long time, let's say about 8 to 9 years, we are seeing a double-digit growth coming back to the sector and retaining over there. So non-food credit growth for the banking sector was close to 16% on a YOY basis. This is the best growth that we have seen since 1st of November 2013, when the growth was about 16.8%. Overall, the credit growth was around 15.5% YOY, the best in 230 fortnights, or the best, since 1st November 2013, when it was around 16.44%. So the deposit momentum has started to pick up. We saw a bit of decline in the previous few fortnights. Now it is at 9.5% growth on a YOY basis. The advances growth, as I mentioned, at 15.5% YOY, augurs well for the large banks who have been capturing market share from the mid and smaller banks. Back to you.
Abhishek, thanks a lot for that. Let's go close to Ekta then. Ekta, the Oro Pharma observations look quite benign, so maybe there could be some covering today.
Well, yes, Anuj, but the proof of the pudding is really in terms of what the reply to the US FTA would be from the Aurobindo management and how exactly they would think the observations are dealt with. So while we say it's positive, it might just be a complete different factor which the US FTA might consider. So just based on what we know as of now, we have accessed the Form 483 which was issued to Aurobindo's Unit 11. It was inspected from July 25th to August 2nd. They issued 3 observations to the plant. It is an API non-antibiotic facility. It was classified as an official action indicated in May 2019, received a warning letter in June 2019. So it already has issues on this particular facility. Whether or not the US FDA thinks these 3 observations are enough to lift the warning letter, time will tell. But the chatter is that yes, maybe these observations are sufficient enough for them to get cleared from this particular facility, and hence I would possibly go with a green. But in these cases, it's really difficult to tell what the US FDA is thinking.
Okay, thanks a lot, Ekta, for that. We'll keep an eye out on Aurobindo Pharma. But Tata Consumer is also in focus this morning. Mangalam is here to tell us why he's watching that one. Mangalam, over to you.
Well, if this happens, and these are newspaper reports, if this happens, it could perhaps be the deal of the year in the FMCG space. And the news is that Tata Group has made an offer to acquire some stake in Bisleri International. It is a part stake that they will make the offer to acquire, and thereafter they will scale that acquisition or scale the stake as well. They could either acquire it via the group or they would acquire it via Tata Consumer itself. Either case, it would be a positive for Tata Consumer, because what they acquire at the group as well eventually goes to the verticals which handle it itself. The reason why this is a big positive is because, one, Bisleri has a strong brand, has almost 32% share of the organized packaged drinking water market, which is about 20,000 odd crores, growing fast, and is a high margin business as well. And Tata Consumer, of course, we've written to them and they've said that they do not comment on market speculation. They haven't denied it. This is something we will monitor extremely closely, because in the past as well, they haven't shied away from inorganic acquisitions, the kinds of Soulful, etc. So if this does happen, by virtue of the strength of the Bisleri brand, this could be a big one.
I mean, very few brands would come close to being as well known as the Bisleri brand. So that'll be, as Mangalam pointed out, if it happens indeed, the deal of the year in the FMCG space. Mangalam, thanks very much. More stocks with news flow. Sonal is here with that list. Sonal, hi, morning.
Good morning, Prashant. Let me start with Anupam Rasayan. A bit of negative news for the company. There is a fire incident at their plant in GIDC. Though the company says they are still assessing the amount of loss, this capacity, this particular unit has the lowest capacity in the 6 units that they operate. And they also have the losses of assets or profits covered under insurance, but they will let us know the amount very soon. Suntech Realty has acquired 7.25 acres of land parcel in Beverly Park in Mira Road. The development potential is around 2.5 million square feet and a revenue potential of 3,000 crore rupees. DB Realty, it's an interesting business line report which suggests that Adani Realty is in advanced talks for merger of DB Realty. DB Realty, remember, has a portfolio of 100 million square feet and around 628 acres of property, primarily in Mumbai. Remember, the Godrej Properties deal did not get through, where they bought around 10% stake in the company. So progress here will be monitored. However, this is just a report and not independently verified by CNBC-TV18.
Okay, Sonal, thanks a lot for that. Making his debut for CNBC-TV18, Vivek here with Stocks and News. Vivek, good morning and welcome to the team.
Thank you so much. Well, a couple of infrastructure stocks on my radar when you're talking about Adani Transmission and Reliance Infra. Some interesting news flow coming in. What's actually happened is that Reliance Infra has gone ahead and filed a 13,400 crore rupee claim against Adani Transmission. What they are saying is that Reliance Infra has actually said that Adani Transmission has breached a certain term as far as the contract in 2017. Now remember, this particular contract was for the acquisition of the power business as far as the Mumbai circle was concerned. So both of these stocks will remain in focus today. The other stock on my radar is the KEC International. Some positive news flow coming in. Another listed stock, Gujarat Industrial Power, has given a contract worth almost 244 crore for this particular company. And this is for building a pooling substation in the Kutch area of Gujarat.
All right. Thanks a lot for that, Vivek. And welcome to the team and all the chaos, the craziness, right?
And the fun as well. Right?
And the fun, of course. How to deny that? Okay, well, let's do a quick recap then of our top stocks. Stocks with positive news flow: ICICI Bank, HDFC Bank, SBI, Aurobindo Pharma, Tata Consumer Products, Suntech Realty, DB Realty and KEC International. While stocks with negative news flow today, Anupam Rasayan and Adani Transmission. But let's also get a quick handle on what's happening in the world of commodities. It gives us a good indication of which way things are headed, especially because we have a big event upon us.
Welcome back. The SGX Nifty is a bit flat, just up about 10 points. I guess a lot of the move has already happened in our market. So let's see how things move. Prakash Diwan is now joining us first up on the show. Prakash, good morning. Thanks a lot for joining us. The massive moves in the last 1 week have happened in the cement space. Of course, Ambuja and ACC have had their own reasons, but something like Shree Cement, after being thrown out of the Nifty, has actually rallied about 15%. Your views?
Good morning, Anuj. So I think cement is probably one of those major sectors that's going through a tectonic shift in terms of how revenues and how costs would pan out for the next 18-24 months. In the backdrop that demand is going to be extremely positive, it has been anticipated that all these capacities that are coming in will probably start coming into the market only post FY25. Until then, there's this huge demand uptick, which is going to be constrained by some sort of distribution and supply as well. Now, in that context, if you analyze, Shree was available, because of this Nifty shift. Out of the Nifty, there was some liquidity that got absorbed. And this has always been something which has been very low on float. And that's precisely the reason why the fundamentals were still attractive. The float kind of made it possible for a lot of institutional investors to buy in. And I think that tells you a story that very clearly cement is going to continue being one of those most favored sectors given the large market capitalization that it offers in some of the Nifty plays. And now with Adani's putting their weight behind the ACC Ambuja twins, it is only going to get even better. So my pick on the large cap remains Ambuja. Of course, it's rallied quite a bit, rallied hard from that 385 cutoff, which was part of the open offer. But smaller companies also will continue to spark up because of this potential M&A consolidation expectation, which is probably going to pick up steam in the next few months. So it remains a sector to be overweight on in terms of a cyclical revival. But you'll have to be picky because there are a lot of companies which probably don't offer that kind of fundamental potential to get re-rated as much as some of the other ones do. So be selective, but definitely I think we'll see a lot of institutional money chasing some of these good names here.
Okay, that's on the cement space. Prakash, hi, good morning. I wanted your thoughts on DB Realty because there's reports that Adani Realty could be looking for a merger. I know DB Realty has been a dead stock. I mean, it's been a stock not really in great favor, but they have good assets in the city. How would you approach this now from an investor standpoint?
Yeah, good morning, Sonia. Yes, so interestingly, DB was always a very good candidate to be acquired by any other player who had the execution skills, who had ability to brand it in a better way, get out of that tainted phase that DB has been going through. And we saw a lot of attempts being made in the past. And I think the clear indication was when some of the marquee names, individual investors, some of the largest investors, smartest brains in the investment community put their money into this name. But then nothing much happened. It's just that this newspaper reports probably brought attention back to the company. But look at where reality is heading, and especially the Mumbai-based stocks, Sonia. You look at Oberoi. I mean, their launches have been lapped up, even if they've been at premium. The average rate at which some of the new projects are going are phenomenal. So we've seen how the Worli project is kind of building such quick traction. We've seen Century face the same thing with their Worli project. Today, Suntech is acquiring something which sounded a bit oxymoronish, Beverly Park in Mira Road, but then it tells you that there's enough activity around real estate in Mumbai. So if that were to happen, DB has great assets, as you rightly said. It just needs a great execution partner, and it's available at a fairly decent valuation from that perspective. I mean, it's just kind of 50 rupees of book value. It's available at 85, so it's really not out of sync. It just needs good execution skill. So if that were to happen, of course, it's going to be a game changer, and the stock could probably get out of this sleepy phase that it has been for a long time. But I would want to see something concrete happening just beyond this newspaper headline that's come through.
Okay. Well, there's a very interesting headline that's come through on the tech space. So Google will be conducting a limited one-year pilot program to allow fantasy games to be distributed through the Google platform. And Nazara Technologies is actually the stock on our radar because I think 5% of their revenues comes from these skill-based fantasy games. Let's find out what this really means. Remember, these games are currently banned on Google Play for violating the platform's policy on gambling. To assess what this could mean for Nazara, we are joined by Nitish Mittersen, the Joint Managing Director at Nazara Tech. Nitish, what does this really mean? If you can just explain to us, and from your own company perspective, how do you benefit?
Sure. So as you know, the skill-based real money gaming space is, quite large in India. However, over the many years, there has been a lot of regulatory unclarity, as well as a lot of unclarity on how these businesses have to be taxed. And I think the more the clarity emerges, the more it is beneficial to companies like ourselves, that want to follow the law of the land to the last letter. Because today what tends to happen is there's a lot of unlevel playing field. You have a lot of unscrupulous players from outside the country taking advantage of this gray area where companies like us cannot aggressively invest because of lack of clarity. So I think any step that moves towards clarity is beneficial. And I think Google experimenting with fantasy games and rummy games on Google Play is a positive step in that direction.
No, but this is Google experimenting, right, Nitish? But is there clarity from the policy side coming through or not yet?
No, you're right. I think obviously Google cannot lend clarity to the regulatory, but I think a lot of activities happening at the government side, which makes us very hopeful that more clarity will, come across. Even if you see the GST, right? The GST Council has been looking at taxation on online gaming very actively, and we're also very hopeful the next, month or 2 months, more clarity will emerge on the GST side as well.
What kind of games are these? Because one sees advertisements for sort of poker and all kinds of games, right? On all kinds of platforms. So this includes all of that?
No, so Google has specifically carved out right now for fantasy sports and for online rummy. These two, as per the Supreme Court, are, skill-based games. And I believe basis that, Google is piloting with these games.
So for Nazara particularly, what percentage of your revenues comes? I mean, from these fantasy games, it's barely 5-10%, right?
So the skill-based RMG space does 6% of our revenue in Q1 of FY23. And, we acquired OpenPlay last year, which was in that space. And the team is actively working to build this business out for us.
Okay. So
I think the Google Play will definitely, boost us because one, your cost of acquisition becomes lower. There's less friction for people to download from Google Play versus, outside that environment. And secondly, I think organic discovery increases a lot on Google Play.
So this, you were saying that you're looking to actively grow this business, even the real money gaming business. And in your annual report, you had mentioned that you would also be looking to go through the inorganic route. Any acquisitions that you have lined up so far?
In that space, we are in active talks with a lot of partners. I think one thing we are definitely taking a pause on is more clarity on GST and how that plays out. Perhaps once there's more clarity on that front, you could expect us to take some inorganic steps as well.
What could be the size of the opportunity once there is clarity? I mean, is there any way to kind of gauge that? One doesn't know how this will be taken up, developed in a market like India, but any examples from other countries?
The skill-based RMG business already in India is very large. It probably contributes to 70-80% of the overall gaming revenues that are being generated in the country. A lot of these revenues come from some local players, but a lot of it also goes to a lot of international players who are operating in our country. So again, I'll repeat, that I think more clearer regulatory clarity on what is allowed and what is not allowed will make incumbent players like ourselves in a far better position and far stronger position to take a lot more aggressive steps. And this can open up a very large revenue opportunity for Nazara, but we will only do once there is enough clarity for us. We don't want to operate in a gray areas.
And 70-80% of the 70%, 80% of what is real money skill-based games?
The overall revenues that are generated in India
from gaming. Okay, all right. And what is the number total overall?
It's probably 15,000-20,000 crores a year. I don't have an exact number.
And 70-80% of that is exactly this RMG.
Fantasy sports, online rummy, online poker.
Okay.
Any games that are played for real money. But these are skill-based games, so they don't fall under gambling. That aspect I'm talking of. I'm obviously not referring to any gambling-related businesses.
Okay, one final question then, Nitish. In the quarter gone by, your margins were under a lot of pressure because there were high amount of ad spends, there was high content spend as well. Is that a trend that will continue in the quarters to come? And can you give us an average number?
Yeah. No, we are very happy operating at low margins at this point of time, like I've said, many times. For us, I think what is really important is to grow aggressively. As you saw, year on year in Q1 of FY23, we grew by 70%. So our thinking is very clear. We don't want to fuel growth by burning a lot of cash or by getting into losses. As long as we can maintain profitable growth, we are very happy maintaining low margins. But I think strategically that is the right for us to do. Trying to optimize margins at this stage for us will be a very large sell pull that we would do for ourselves.
Okay. All right. All the best. Thanks a lot for joining in. That's Nazara Tech. Prakash Diwan is still sitting by with us. Prakash, this is a stock that has eroded a lot of money for investors. I mean, the last 12 months, the stock is down about 20%. Do you think that its fortunes can turn anytime soon?
So, Sonia, one of the most promising things about this sector is that this sector might grow at a pace that is not very desirable. Or it's lower than what you would expect. But this is a sector that is bound to be a sunrise sector of sorts. I mean, there's no way gaming cannot start padding up its revenue growth significantly in the years to come. It's just a question of at what cost does this growth come? And as the management was very clear that we don't want to keep on burning cash to, just for the sake of increasing revenue. But as and when that revenue grows, and we've seen that in a maybe not comparable way, but in a indicative way of sorts with Delta Corp, some of their online gaming versions have kind of really grown significantly in the last few years, not at the pace that was expected to begin with. But it is a stock that's probably expensive, but it's a stock of the future. So you want to buy it, you could probably buy it at lower levels. It's probably been priced very steeply when it came with an IPO, and that's what you're paying the price for. But at this point, I think it's definitely got a lot of things going for itself. And news like Google Play getting onto this particular segment, as I mentioned, even on Friday, is a positive, and you'll probably see much traction from some of its verticals that this company is into. But growth will come at a pace that's probably lower than what the price tells you at this point in time.
Okay, let's do one thing. Prakash, stay on. We'll just take a quick break. On the other side of the break, we'll have our technical guests coming through with us. Mitesh Thakkar and Sudarshan Sukhani will be joining in for some technical trades. Stay tuned.
Welcome back. We have Sudarshan Sukhani and Mitesh Thakkar joining us. The SGX Nifty is now picking up some pace. Though the SGX Nifty has really not mattered for our markets, the global cues, etc. The market's been having a momentum of its own, and every dip, small or big, has been bought into. Gentlemen, good morning. Sudarshan, let me start with you. The market clearly on some kind of steroids, right? Just a one-way move. But what next? Do you get a sense that this market could take out 18,000 and trade above that? What should be the strategy?
Good morning, Anuj. Yes, I get a sense that the market should take out 18,000 and for all we know could move towards new highs. So that is not, I mean, I can't predict it. I can just say that given the environment just now, given the chart patterns, new highs are a possibility. Now, what are the chart patterns? For 5 days, the Nifty went into a huddle into a very narrow trading range. First, it broke out of that trading range on the upside. Then there was that significant resistance in the 17,750, 800 area. It broke out of that resistance. So a market that breaks out of resistance levels is a market that we want to be long in. So the idea is to be long in the Nifty and the Bank Nifty both. Keep approximately 100-point stops. So I would give a number, just wherever you enter or from the opening price, keep a 100-point stop, but be long. And today, since the SGX is opening almost flat, almost, it's better to be long at the open itself.
Okay. And on the Bank Nifty?
The same, Bank Nifty has been outperforming. So I would think that it's better to be long in both the indices and then let the market take over.
Okay. Mitesh, good morning. Your approach on Nifty and Bank Nifty today?
Good morning, Anuj. See, broadly, I think, we are now at the upper end of the area when kind of we've seen historically supply emerge. I think yesterday the intra-week high, Anuj, was on the weekly trend line, which Prashant had been highlighting a couple of weeks back as well. So I think getting past 17,925, 17,950, I think would be the next breakout. Till then, I think, I would be slightly slow on the index and use dips to buy into, but the overall bias is clearly on the upside. I think with the sector rotation happening, I think IT could come into play, and therefore I would be looking to trade the Nifty, IT as well as IT stocks.
Yeah, that's something that, I refer to as well. Maybe there's some sector rotation. Mitesh, what about individual stocks?
Yeah. So, Anuj, I have more of buy calls today, 3 buys to a sell. On the buying side is Mindtree with a stop at 3250 for targets of 3400. FSL or First Source Solution, that's a buy with a stop at 113.5 for targets of 124. Concor is a buy with a stop at 730 for targets of 795. And PVR is on the selling side that had some kind of a breakdown on Friday. Keep a stop at 1860, look for targets of 1770.
Okay, and Sudarshan, what are you buying and selling?
Primarily buying. Apollo Hospitals is a buy. It broke out of a small resistance level. Relative strength is strong. Momentum is up. Buy with stop under 43.80. HDFC Bank, surprisingly, very, very rarely comes in my list. It's a choppy stock, but it's a buying opportunity. It's on the verge of making new 3-month highs. That's a buy with a stop under 14.80. I have only one intraday short selling idea, ICICI General Insurance, ICICI GI. It's an intraday short with a stop under 12.43. And finally, another buy, Petronet. It was on Thursday also. The stock has done well on Friday, not broken out yet. Anticipating a breakout with a stop under, buy with a stop under 213.
Gentlemen, thanks a lot for those calls. We'll come back to you at 9:10 to revisit them. For now, we'll take a break. We'll come back with pre-opening rates, some F&O calls, and also we'll connect with Umesh Chaudhary of Titagar Wagons, as the company has divested its holding in its Italian subsidiaries. All that lined up after the break.